Welcome back to Metropole Television. This is Business. I am 2146. That's your SMS line at Metropole TVKE across all your social media platforms. This is officially Economic Review this morning. Let's jump into the issues that we have for you. Now, the Central Bank of Kenya directive to banks to restructure loans as a way of relief to borrowers owing to the COVID-19 pandemic has left a section of lenders in limbo as their customers face uncertainty in their businesses. In March, the Central Bank Governor, Dr. Patrick Njoroge, announced that Kenyans who will find it hard to service their loans because of the coronavirus pandemic request their banks to issue 1-year extensions. Now, despite having complied with the directive, lenders now worry that some of their customers may not be able to resume payments due to the total closure of their businesses as a result of the effect of the COVID-19 pandemic. According to data from the CBK, 7 of Kenya's largest banks have restructured a combined 176 billion shillings worth of customer loans by the month of May. Joining us this morning, therefore, to give us insight into this issue, we do have the CEO, Miradi Capital, Abraham Mathogo. I'll be introducing the other gentleman who will be facing us, who will be also joining us shortly this morning to continue discussing our bigger issues. Now, Abraham, let's therefore ask this question. What do you make of the woes of the financial institutions now that they say that they have been left in a desperate situation in a bid to cushion their customers?
You see, Elijah, with the financial sector, what normally happens, the cows come home to them in the end. So what is happening now is that whatever has been going on everywhere has now come home to roost within the banking sector. And I must applaud Dr. Njoroge, the governor. I think he saw this very early, and that's why he went the restructuring route, where he told banks, you restructure whatever you need to restructure, so that you for two reasons, and the restructure works for both parties. For the client, it gives you a reprieve because you have no cash flow to pay your loan. But for the bank, what it did is that it improved the quality of their asset, because had they continued treating the debts the way they were treating them, then basically by now would be having a massive toxic debt. And remember, he even went further and revised the rules of how you decide the quality of assets. Okay, I have my views as to whether that is consistent with IFRS 9, but the issue here is, I think he took the precautions. So to answer your question, what the banks are seeing is just the manifestation of what the malaise in the economy is now coming home. So for now, I think for now the restructuring may work. But if you look at it in the long run, banks cannot cure the economic problem. They are passive in it, in the sense that whatever happens in the economy comes home to them. So it is up to government through policies, that is fiscal and monetary policy, to jumpstart the economy. Because you can restructure the loans all you want, but for as long as there's no cash flow coming, we're just postponing pain. Eventually, we'll have to bite the bullet at some point.
All right, Abraham, I want to take you back to the data that we have right now, and I will be going back to a bite from the CEO, BD Credit, on exactly what has happened around this area. Now, 176B has been provided for these restructured loans by the top banks in the country, and I know you looked very well at the half-year results of these banks. You would see how most of them are saying that we have provided for the restructured loans immensely. So from a banking perspective, Abraham, what is going to be the effect of these massive restructured loans in the industry?
It will have several impacts. Number one, when you take a provision, that means you take money out of your capital, either money out of your capital or money out of your profits. So it will depress profitability and also cut back on capital. Now, the other part that we all hope doesn't happen is what happens when your level of toxic debt or your level of provision that is required exceeds your capital. What's going to happen? And those are possibilities. So those are the things that worry me, because if we do not cure the economy, this balloon will get bigger and bigger and bigger. And now what may happen, let me not say it will happen, is that the lower tiers, the tier 3, the tier 4 banks may start feeling the heat. Because if you have capital of 1 or 2 billion, then you can only take so much provision, after which you either shut down or increase your capital. You saw it in the paper yesterday, I think a week ago in Business Daily, a bank I shall not name, whose toxic debt now is at 90%. You saw that. You see, so a bank like that basically means that bank is not a going concern, with due respect. Or even if it is, not for very long. So those are signs that we need to be careful. And that tells us that we, by providing restructuring, that is dealing with symptoms. We are not curing the problem.
Fantastic.
So basically, yeah, it is that parallel you take because you have a headache, but this headache is persisting. So let's find out what is causing the headache.
Yes. All right, Abraham, I want you to listen to a bite from the CEO, BD Credit, on exactly now the position that they find themselves in with this massive restructuring. And then you can come back and really tell me now the position that some of these lenders find themselves in. Let's take a look at that.
I would, for example, give some of our customers own schools. Like I know 2 or 3 who have been, who came to see us recently, who own private schools, and right now the schools are closed. And even as you restructure, you cannot tell with certainty, you are restructuring to what by when, because until we have certainty as to when maybe schools will open. Others are people who could be operating businesses that have been, currently been stopped from operating. You are aware that clubs, bars, wines and spirits, those sort of industries right now are not operating very, very well. And, they have been affected. So obviously some of them have come to us, telling us that, look, our business is grounded at the moment, and we have to listen and we have to see, to meet halfway and see what we can be able to do to accommodate them, because some of them have been our customers, very good customers for a very long time.
Fantastic. Abraham, you can hear that there's this fear that yes, you renegotiated for moratoriums, and you could actually see where the CBK was coming from. Go in, go for 1 year, go for 6 months, go for a certain period of moratoriums as we wait for the effect of the COVID-19 pandemic to sort of settle within the economy. But now, Abraham, there is this fear that yes, you did get a moratorium, but what about if now it turns out to be a non-performing facility? Because there's no promise that yes, this effect is going to get done in 1 year, in 3 months, in 6 months that you first negotiated for.
Yeah, you see, a banking horizon for good debt cannot go beyond 1 year. So Njoroge is also praying, like all of us, that it changes. But in all likelihood, the economic effects will definitely exceed 1 year. So that, going by that soundbite, the notions there are very, very valid. That yes, we are now negotiating, but all those are short-term solutions. The mid and long-term solutions is that the economy revives. If the economy does not revive, these short-term interventions will not help. So what basically we are doing is first aid, but eventually some surgical operation has to happen, and that will involve the government shocking the economy through the intervention, through the monetary and fiscal policies. Fantastic.
Abraham, as we clear on this issue this morning, you saw that some CEOs now were sort of grumbling at the perspective that the CBK is looking at this situation. They're saying CBK is taking a customer approach as opposed to an industry approach. Abraham, you do know that even after the removal of the cap rate, the industry has seen just an average of 12.8% in terms of the lending rates. Barely even the 13% that we're enjoying during the cap rate regime. Do you think that now, since these reports are coming out, massively restructuring, NPL that is already at 13.1%, do you think that we're going to see anything from a regulatory perspective from CBK to cushion the banking industry?
You see, cushioning the banking industry may not be very practical. Because first of all, remember Kenya as a bank, if you go by world standards, we are overbanked. So we may see mergers, we may see some banks falling off. I personally, from my seat, I don't know how you would support banks, because banks by the bank nature are intermediaries. They take deposits and they lend them, or they create assets. So that process now is being impaired by the fact that loans that were good before, because the better then, those conditions have changed because of COVID. Now we're having a situation by where very few industries are performing. So cuts across the entire industry. So it is he who has more capital that will survive longer. But if this thing persists, even the strongest will be alleged.
All right, gentlemen, let's move on to the next issue. And at this time, I want to introduce Tommy Wendell to the conversation to help us understand a report by the Transport Ministry, which has revealed that the SGR posted a loss of 21.68 billion in operating losses in the 3 months to May, with total revenue collections of 25.03 billion in the same period against operational costs amounting to 46.71 billion shillings. Now, this means that Kenyans now have to fill the gap that has been posted by the operator, whose fortunes this year have been wiped off as a result of the travel restrictions that were put in place in the economy to help stop the spread of the COVID-19 pandemic. Now, this already means that the Kenya Railways Corporation is in line to default a 40 billion shillings loan repayment to China's Africa Starway Rail Operation Company, which runs both passenger and cargo services on the SGR. Now, the data indicates increased operating costs that jumped to 14.051 billion, a figure that more than doubled the 5.6 billion raised in sales. In 2019, the cargo and passenger trains operational costs also hit 17.976 billion, while the sales rose to 13.581 billion. All right, there have been several conversations that the SGR is a long-term project that we should not expect to make money in the immediate. What do you make of this, Tommy? And should we stop expecting profitability from the SGR right now?
We live in unprecedented times now, COVID around. So this has really hurt the economy. As far as the contract, negotiating it with the Chinese company, was contracted by the Kenyan government, we still don't know the details. We want the detail to come out so we can further scrutinize where and value for money for us as Kenyans. So, but also the structure on the Chinese to give us debt relief. You know, this should kind of help, because no one could predict COVID. No one saw this thing coming. As much as we want SGR to work and be able to give services to the country, there was no way for us to realize that COVID would come and cause this disturbance in the economy that it has. It's not just SGR; it's cutting across everywhere. So it is a long-term project, and yes, eventually it will make money, and yes, eventually it will pass. Yes, we would try and find a way to restructure this deal that we have with the Chinese government, and also we need to know the finer details of the deal. I trust the Transport Ministry, but still have a proper scrutiny of the contracts that they have not released.
Yes, Tommy, you say, well, that nobody predicted the COVID-19 pandemic, but Tommy, even before the COVID-19 pandemic, I mean, the books of SGR were neither here nor there in terms of profitability. They have been a loss-making entity throughout.
Right. Now, government tried to force everybody to use the SGR to move their goods when they made it mandatory. That was a bad move. It still did not cure their economic problems. The way to regulate the markets is the markets regulate themselves in terms of cost-benefit analysis. So you have to make it cheap enough to where an individual sees there is no better way than to use the SGR based on cost. So the government still needs to find a way to do that. Now, COVID is not really helping right now, but that is one of the ways that they could. Their pricing. So they.
Yes, Abraham, I want to bring you in on this as well. You can actually hear Tommy say, well, you can't force the market. The market sort of controls itself. But Abraham, I want to point you out to the cargo business for SGR. That looks like the only light at the end of the tunnel for this operator, because if you look at the sales that we're talking about, it actually did jump to 13B in terms of the process that go from there. Do you think there should be now a bigger focus on the cargo business for SGR? And the big elephant in the room right now, Abraham, is it time for us to go back to China and renegotiate our loan repayments with SGR?
Now, let me put this into context. And we had this discussion when we were discussing KQ. The SGR is not an economic asset. Economic assets, as Randall is a long-term asset. When you put in an economic asset in an economy, you're putting in to spark growth. Then you put in the short run, the economic growth to even profitability. You imagine when the current meter gauge was put by the British, do you think it made money? Do you think it made money in year 1, year 2, year 3? But aren't we benefiting from it today? The one going to Nanyuki. So even when you say we've made that massive loss, in fact, it was interesting. We were discussing that very topic in our economic alumni in our group, and I was telling them, that figure does not include the economic profit of the SPR.
Yep.
So it is a distorted figure. In fact, I was short of writing a rejoinder. So it is total distortion, and this narrative has to stop. It could be the case that SPR is profitable because nobody has bothered to compute the economic profit. It could be that they are loss-making. It's that amount. So as we do this, let's remember that this is an economic asset. But we are saying we put it here to grow this economy. The financial viability of it was based on it getting to Kigali. That is there even in the 50s. But even where it has reached, it still serves Kenya. But it's like looking for orangeness in an apple. You will never find it. So the thing is, let's whenever we do an assessment, let's look at the financial return if you want. But for me, I would be more bothered by the economic return because I know there is, and those methods of computing economic return are there. But see, the easier one is to say, these are very lazy assessment. Looking at how much SGR has received in receipts and how much paid, and do a very lazy. So that figure does not mean anything. And I don't think SGR is a loss-making in the context of the way they put it. And I think it has more benefits than we speak about. I'm not speaking for government. I don't hold plea for them. But I think it's always good to be fair when we are making assessment, Elijah.
Pretty much. All right, gentlemen, just because of time, we just want us to jump onto the next issue with Abraham, just before I bring in Tommy Randall to sort of complete our discussion this morning on the last issue that we have for you. Now, monthly traded turnover at the Nairobi Securities Exchange, NSE, fell for a year low as a general depressed share price affected selling. Data from the Kenyan Bourse indicated that the total value of shares traded last month fell by 22.4% in comparison to July's value, which hit 13.5 billion and is the lowest monthly turnover since August 2019, which recorded 8.7 billion shares in total trade. In a true reflection of the state of the market in the country, which has been heavily affected by the COVID-19 pandemic, foreign investors largely went through a reversal in selling activity, with a curve showing that they leaned toward net buying as opposed to net selling. Analysts now put the market trading to earning ratio at 9.5 times, which also stands below the 11-year historical low of 13 times, with the average dividend currently at 5.1%, 1 point above historical average of 4%. All right, Abraham, what should we blame for the low decline performance at the Bourse, and what is this indicative of the people looking at investing at NSE right now?
See, for me, it's a reflection of the preference for liquidity over investment. Because if you look at our liquid markets, our liquid markets, there's a lot of liquidity in the market. And even the other day, when they look at banks, they're saying there's more money outside banks than ever before. So the COVID has basically shifted money towards towards liquidity, towards actual liquid, as opposed to asset. You know, in the spectrum, right from property on one end, right to liquidity, people are preferring to money. That is what it is.
Fantastic. But yes, Abraham, I want to take you back to exactly what our earning to share price really stands. It now stands at 9.5 times. And if you look at our historic low, it was 13, which is still 3.5 points below what our historic low is. What does that say of the current market status right now, Abraham?
You see, in normal, in fact, Tommy put it very well. We are in very extraordinary times. So, and this is again another short fall of our analysts. We like to compare periods that are not similar. You see, we are comparing this period with a similar period last year. There was no COVID last year, at that time. So what really are we comparing? That's why sometimes it really beats me when, it's easy to throw figures around, but it's good to contextualize them because we are not comparing like period. This is a very unique period. This period should not actually be compared to any other. It should only be looked at it in its own context. And in the context that people in this time, because of uncertainty, prefer to keep their money in liquid form. In fact, they're saying even people are preferring to keep their money outside the banking sector. So that's how paranoid people are.
Yes.
And keeping it in dollars. So you can see it's not that the economy has shrunk, but not to the extent to which it has affected the polls.
All right. Now, Abraham, if you can allow me, just because of time, let's jump quickly into the last issue this morning. We want to bring in Tommy Wendell to actually also weigh in from a policy perspective. Now, reports from the Auditor General's office now indicate the ministries failed to account for 16.8 billion spent in the year to June 2018, which raises doubt on their reported spending for the period. Now, failure by ministries, departments and agencies to fully support payments cast doubt on the authenticity of the expenditure reported as incurred. The latest report of the Auditor General tabled in Parliament now states. Now, some of the departments that have been put on the spotlight include Department of Infrastructure Expenditure, the Broadcasting and Telecommunications Department, and the Special Programs Department. Past audits by the former Auditor General Edward Ouko have suggested collusion by civil servants and private entities to steal billions of shillings from the public coffers, with his office saying that overhauling a procurement and payment system that is easily tampered with is central to halting the looting. Now, Tommy, another case of fraud or corruption, and what are the implications of this unaccounted for expenditure?
Now, we have a very big problem when it comes to transparency in our government, especially when it comes down to spending. And it's a totally bad system from tendering all the way to procurement. We need a proper system that is transparent, where one can view and account for everything that is going on, so that later on, when we have these kinds of audits, we're not going to be surprised about where money went. And when we have this kind of audits, then we can be able to actually hold somebody to account and say, okay, so yeah, the ministry paid this much. What did we get back as a ministry? What did we get back? Did we get value for money so that the citizen isn't hurt? People like to toss around this word Wanjiko. All this time you're wasting all this money, you're hurting Wanjiko. But also, all of us who are not Wanjikos, we still pay taxes, and we want to know that our money is being used for what it's supposed to be spent on. Right. So I would suggest they overhaul that. They have a transparent system online where everybody can go and see everything. This is not something new. This is something that should have been done a long time ago.
All right, Abraham, now this has been a recurring problem. I mean, I don't know where you put it on corruption. I mean, so what does the government need to do to crack down on the vice once and for all? And Tommy is saying that, well, there needs to be a system that is accountable to every state department. But I would like to think there is that system. The president has been calling for every procurement process in the government to go online so that it is in the public domain.
Personally, what I think is that you can see we are very good at finding out something has gone wrong. We need to free expenditure. Don't forget, when you look at most of these transactions, they were actually done legally. Because when they go to court, some of these people actually win. So what we are saying, even the systems we have in the legal some people can go around them. That's why, because if you look at it, if you read how many bills have complied with the law and they are not scandals. Also, the list you read is not even, there are more. So there's a problem with the system pre-expenditure. Because finding out something at audit stage, basically you're a mortician, you're just coming to bury the dead. We have to ensure the person does not die in the first place. And how do we do that? We have to procurement system, because that's where money goes. The laws changed the other day, but still you can still see these things are happening. But then again, sometimes it's about controls are about two things: systems and people. Then maybe also I need to think about how do we get these people on board. We have Chapter 6. Is Chapter 6 working for us? Because all these people have gone through Chapter 6. So as far as they're concerned, legally, they are irreproachable in terms of integrity. But those people go and do those things. So we also need to think about how is it that we bring people on board? Is there a way we can get better people on board? People with morals, people who fear God. Because at the end of the day, if you're a moral compass, if you have a belief in a higher power of God, there are things you will not do even without the law. But a bad person, no matter what law you put them in, they will still do bad. So we need to think hard and fast as a country. At what point we will stop being legalistic and start being moralistic? Because that is the only way we get out of what we are in right now. Elijah.
Fantastic. Tommy Randall, Abraham Vogo, the CEO of Miradi Capital, thank you very much for making this show this morning quite a success that it has been. Always a pleasure speaking to you two gentlemen.
You're most welcome.
Elijah.
All right. We take a short break here on a Business AM, but let's talk about KRA. I mean, we know the position that they find themselves in right now. I mean, and we have seen exactly what the litigation processes are going to be this year, with news that they have already identified 259 individuals who have been avoiding tax payments. Now the question is going to be, what is the ADR system that was also put in place to offer a substitute to litigation process in this country? What has it gained? And if anything, is it going to help KRA at least realize something in this financial year once we come back here on Business AM?